I recently watched a YouTube video about an illiterate farmer who lost 5-6 lakh rupees in stock market. He said he lost money because he was uneducated. The interviewer also says that if you are not educated, you should not trade. This got me thinking because SEBI says that 90% of the traders lose money in trading. So does that mean all these traders are uneducated? I don't think so. I believe most traders, at least 80 to 90% of them have graduated from college. Some people, at least 20 to 25%, even have MBAs. But still people lose money, right? Why? And some people, even they have graduated from top colleges like IIT or IIM, but still lose money in trading. Why is that? Do you know Mahendra Singh Dhoni? He is the most successful captain for the Indian cricket team and he has won T20 World Cup, ODI World Cup, ICC Champion Trophy, ICC Test Match, and the list goes on and on, right? During his leadership, all these players have emerged and conquered the world's cricket. Have you ever wondered why Dhoni achieved significant success compared to other cricketers? The one word answer is calm mindset in pressure situations, right? Now, coming back to trading, ever wonder why people still lose money even with all these profitable trading strategies floating around on YouTube and the internet? Well, there are 5 big reasons behind it. In this video, we will dive into each one and talk about what's going wrong, and most importantly, we will explore some solution. So without wasting much time, let's start. Number 1 reason, unrealistic expectation. You ask one question to any person who started trading recently. How much money you are planning to make every month? Most people say I'm planning to make 40,000 to 50,000 rupees every month. Next, ask one more question about their capital size. It will be around 2 to 3 lakh rupees in India. It means people are planning to generate 20 to 25% of the returns every month on their capital, even though they are very, very new to the markets. The world famous investor Warren Buffett has generated only 20% average gross year returns every year, not month, okay? And all of us aim to generate 20 to 25% returns every month. Credit goes to some random videos where they show that they make 25 lakh rupees or 50 lakh rupees in one day. Friends, most of these profit screenshots are fake. Don't follow it. Even if a trader posts a verified link, please calculate the profits in terms of ROI and the capital. That's very, very important. And second reason is assumption of winning sequence. I will toss a coin and you have to guess whether it is a head or tail. The probability of head or tail is 50%, right? It means if we toss a coin 100 times, 50 times we get head and 50 times we get the tail. Do you agree, friends? Does it mean we get head and tail one after another in the same sequence, like head, tail, head, tail, head, tail? No way, right? We may get head or tail continuously for some time before we get the opposite side of the coin, right? Now don't you think we should apply the same logic in trading as well? Let's say you have a 70% trading strategy. I mean, the accuracy of a trading strategy is 70%. It means out of 100 trades, 70 are profitable trades and 30 are losing trades, right? Do you think we get one profitable trade after a losing trade every time? It means like WL. W stands for winning. WL and L stands for losing. WL. No, right? Our expectation itself is wrong, right? So there is also a possibility of getting many losing trades in one stretch, one after the other, right? For example, WL, right? Now, what if we risk 5% of our capital on each trade? Easily we lose 25 to 50% of the capital when we face that situation, right? Number 3, options buying versus option selling. I will not get into the debate of who is right here because you can make money with options buying and option selling if you are right actually. And you will lose money in both options buying and option selling if you are wrong, right? But I want to highlight the technicalities of options trading. Because with options buying, accuracy is less, which means you get more number of failed trades, but when you are right, you make more money, right? But with options selling, accuracy is high, which means you get more number of successful trades, but when you are right, you make very less profits, right? And when you're wrong, you lose more money compared to the winning money, right? Now, if you don't know this, or if you don't agree to this, I suggest you to refresh your knowledge about options trading, friends. Now, let's say you are an options buyer. Then you will face two major challenges. Number one, you should be ready to face and digest more number of failures. And number two, the total loss of these failed trades should not consume more percentage of your capital. For example, even after facing 10 losing trades in options buying, you should not lose more than 25% of your trading capital. This is the logic. Number fourth, revenge trading. Did you ever fail in school or college? I failed in 2 subjects during my second semester of engineering. No one said anything to me directly, but I felt humiliated by people's reaction. It was like I didn't matter anymore. This made me feel really troubled. So I decided to study hard and to perform better in the next semester. So when the results came in the next semester, I not only passed the 2 failed subjects, but also became the top student among boys. Now, do you think this is a good attitude to have in life? Especially in markets? Maybe not. Because the same attitude can bring major losses in trading. Let me explain. So most of our upbringing taught us that failure is bad, and whenever you face a failure, you should take counteraction or immediate action to overcome it, right? But we can't get 100% success in trading, and there will be failures in trading for sure. The best solution is not to react to these failures and continue with the same trading setup with the same money management rules. But when we face 1 or 2 failures in trading, we end up taking either unnecessary trades or more risk in the next trade, or we commit both the blunders. This is revenge trading. Number 5, changing strategies. MS Dhoni is one of the most successful and highly respected cricketers in the world, right? Do you think he would have achieved the same result if he played cricket for 1 year, football for the next 1 year, and tennis for the next year? It sounds really funny, right? But traders jump from one trading strategy to another trading strategy every month, and they believe they can make more money in the market. Friends, consistency is crucial in trading because it allows us to fine-tune our strategy, one single strategy, and learn from our mistakes. Constantly switching strategies disrupts this learning process and prevents traders from mastering any particular approach. I hope all these issues made sense to your mind. Now, let's understand how to overcome these issues in trading. Number 1, how to fix unrealistic expectation. Expecting only a 2% returns on your capital each month is trading is considered as reasonable returns. It allows for steady growth without taking excessive risk. By aiming for consistent and moderate gains, you can avoid the pressure of chasing high returns and the potential for large losses. This approach emphasizes the importance of risk management and patience in achieving long-term success in trading. Number 2 reason, assumption of winning sequence. So always make an assumption of getting 10 losing trades in one stretch. If you face that situation, you should not lose more than 25% of your capital, friends. So if you risk only 2.5% of your capital per trade, after facing 10 losing trades, you lose 25% of your capital. So you should also consider brokerage, taxes and slippage in trading, right? So you should not risk more than 2% of your capital per trade. Number 3, how to fix options buying and options selling. See, if you are a person who can't digest more number of failures, then options buying is not for you. I will repeat, if you are a person who can't digest more number of failures, then options buying is not for you. You can switch to option selling or even equity trading. The biggest risk in option selling is it can cause more loss if the trade idea goes wrong against you. So you should ensure execution goes smoothly, because nowadays we hear a lot of spike issues. One single spike can wipe out your entire capital. So you can go for the stop loss placement, or hedging is mandatory to avoid this kind of situations. But you should also remember, hedging reduces your profit a little bit. So you need to take a call. You go with option selling or equity. So if you think all these things are complicated, you can always switch to equity trading. That's always there, right? And number 4, how to deal with revenge trading. See friends, avoiding revenge trading involves implementing strategies to control our emotions and maintain discipline. See, limiting the number of trades per day, such as a simple rule of 3 trades per trading day, can be an effective solution. So this rule helps preventing the impulsive and emotional decisions driven by the desire to recoup our losses, right? By setting clear boundaries on trading activity, like 3 trades per day, traders can step back, assess the market conditions objectively and avoid falling into the trap of revenge trading, right? So follow this rule, 3 trades per day. That's very simple to avoid revenge trading. Number 5th, changing strategies. How to avoid the resist of changing strategies. To resist the urge to change strategies in stock market trading, it's important to have a confidence in your trading approach. So first I will do is backtest a trading strategy in depth. And once you finalize a strategy, never ever think of changing it. Remind yourself that success often comes from consistency and patience. Keep track of your trades, all the trades, and objectively evaluate the performance of your strategy over time. Maybe after a week, after a month, after a quarter, like that. Remember, no strategy is perfect, but consistency and discipline can lead to long-term success. And finally, one more common solution is meditation. Try to meditate daily for at least 30 minutes. By practicing meditation regularly, we can reduce our stress and anxiety level in the mind, which are very common in the fast-paced and unpredictable nature of the market. This clarity of mind enables better decision making, helping traders to avoid impulsive action driven by emotions like fear or greed, right? If you have taken at least 50 trades in a live trading account, then you realize trading psychology is more important than trading strategies, right? Because controlling our emotions in the live market is most important aspect to taste success in trading. I will suggest 5 best books to improve your trading psychology. Don't worry, I will also share the links in the description. Number 1 book in the list is Trading in the Zone. You will see this book in most categories of stock market. This book starts with an introduction to fundamental and technical analysis and how we can use these concepts in our trading. This book also explains the dangers of trading, taking responsibility in trading, and the impact of our belief systems in trading. This book will teach you how to set yourself up for success by developing powerful mental habits and attitude towards your trading. Number 2nd book in the list is Reminiscences of a Stock Operator. Jesse Livermore is one of the most famous traders in the history of stock market. This book follows his life from his childhood until he becomes a top trader to gaining fame as the greatest bear of Wall Street. Jesse made several $1 million during the 1907 and 1929 market crashes. He was carrying a massive short position during the 1929 market crash and made over $100 million, which is equivalent to over $1.6 billion in today's dollars value. It is a must-read book to understand the thought process of a successful trader. Number third book in the list is Trade Like a Monk. This is the first and only book by an Indian author and wholly dedicated to trading psychology. The four primary emotions evolving around trading are greed, fear, regret, and hope. We must develop a little extra control over these emotions to develop good trading psychology. This book conveys the importance of these emotions in trading through different simple stories from day-to-day life. Trade Like a Monk helps developing a strong trading psychology, which is essential in the trading business. Number 4 book in the list is Trading Psychology 2.0. This book is written by Dr. Brett Steinberger. It is a must-read book for traders who want the best chance at success in this highly competitive industry. Dr. Brett is a verified expert on mental health and his work at SMB Capitals was highly successful. He has taught as a professor for the State University of New York, emphasizing solution-focused therapies to help people. So Trading Psychology 2.0 gives a detailed guide to applying the science of psychology to the art of trading. Number 5th book in the list is Atomic Habits. The author of this book is so confident in its method that he believes that they can change your life forever. Even for those who are not interested or not ready to make significant changes, there is still much worth learning from reading this book about what habit works best and how we form with such certainty. Because the habits we form can be powerful or harmful to our health, right? Developing the right ones is essential, but breaking the bad habits should not be overlooked to achieve success in stock market. That's all for today, friends. Thank you for watching. Don't forget to like, subscribe and hit the notification bell for more exciting content like this. See you in the next video.